Now, HDFC, after the numbers yesterday, corrected, but today HDFC is looking stable. For the quarter gone by, which is Q3, the company has reported a uptick of about 16% at PAT level. Keki Mistry now joins us. Mr. Mistry, good morning. Thank you for joining us. Could you walk us through the key drivers for your net profit growth for the quarter gone by, which is Q3?
See, key drivers of profit has been a higher net interest margin. Net interest margin went up by about 1 percentage point. Spreads went up by 1 basis point. 1 basis point is not a big amount, but it went up by 1 basis point. But the biggest driver of profit growth was the growth in individual business. So individual business went up by as much, when you add back the loans sold in the last 12 months, went up by as much as 31%. So we continue to see a very strong, robust growth in the demand for individual home loans. And this is notwithstanding the fact that interest rates during the last 12 months have been on the higher side.
Right, Mr. Mistry, could you take us through your loan growth this quarter around? We've seen individual loans contribute to the bulk of your loan growth this year. What is the outlook on this front going forward?
See, historically, we've always talked of a growth of 18 to 20% a year. We are not going to change that 18 to 20% to a higher number, even though the way things are looking now, things look to, the overall environment looks to be a lot better. And in 9 months, we have seen the growth to be very robust. Hopefully, that robust growth will continue. But from a market perspective, we will continue to say 18 to 20% growth is a minimum that we would target.
Keki, give us a sense of your spreads and margins going forward. Do you foresee any pressure given the general downtrend of interest rates?
We keep a very matched balance sheet. We take no mismatch. We give fixed rate borrowers or loans to our customers which are pegged off a fixed rate borrowing cost, and we give floating rate loans to our customers which are also of a floating rate cost. So there is no interest rate mismatch that we take. And that is the reason why when interest rates were going up, we did not see any significant change in spreads. So even when rates are coming down, we do not believe that we will see any significant change in spreads. If you take the last decade, our spreads have ranged from a low of 2.15 to a high of 2.35. And more specifically, for most times, have been between 2.2 and 2.3. And I would expect spreads to remain in that range.
Right. Are you expecting the RBI to cut rates significantly in this policy statement? And if that happens, would you look at cutting your own lending rates? Because that's what the market is keenly looking out for.
I don't know whether it will be a significant cut. Personally, in my view, I don't think it will be a significant cut. But I think there will be a 0.25% cut in rates in January. And RBI will watch again for the next couple of months, everything else remaining the same. My belief is that in March, RBI will probably cut rates again by a 0.25%. So between January and March, my belief is that RBI will cut rates by about 50 basis points. Now going forward beyond March, into the April to December quarter, I would expect more rate cuts to happen. Clearly, I think if you were to talk in, say, January of 2014, we would be looking at an interest rate environment which is much lower than what prevails in January 2013. But the exact quantum of rate cuts obviously will depend on data as it emerges, inflation numbers, GDP numbers, IIP numbers, the fiscal deficit numbers which will be announced in the budget, and so on and so forth.
Keki, we have seen your asset quality improve from last 32 quarters, especially at a time when rest of the industry is grappling with NPA issues. What is your sense on asset quality going forward?
See, as you correctly mentioned, we have seen 32 consecutive quarters where the non-performing loan level was lower than what it was in the previous year. And these are gross non-performing loans. On a net basis, our non-performing loans are nil because everything is provided for. So if we've seen 32 quarters, hopefully we'll see a 33rd quarter. I mean, to be honest, we don't see anything today which would give us any cause for concern in terms of asset quality.
Right. HDFC, of course, has a huge portfolio of listed and unlisted investments. Could you take us through what is the value of both?